Welcome to NYSE TV Live. I'm Trinity Chavez, and today is Wednesday, May 29th, and we're joining you from the epicenter of global financial markets here at the NYSE, and we have an action-packed show for you this afternoon. We're going to break down the latest ICE Mortgage Monitor report, dive into a study that examines what people trust, what people don't trust when it comes to innovation, and why Wall Street is picking up the pace of trading this week. But before we jump into all those stories, we want to cast a spotlight on Workiva. It trades here under the NYSE ticker symbol WK, and the company is on hand to celebrate its 10th anniversary of listing and will ring the closing bell in just about a half an hour. And to honor the occasion, we have Workiva's branding all over this iconic building, from the cubes behind me above the trading floor to its banner streamed across the facade of the NYSE on the corner of Wall and Broad Streets in Lower Manhattan. Now, Workiva is also doing giveaways tied to some of the NYSE-listed companies here that it works with, and that's happening in Experience Square. The company also has a branded bus right outside this iconic building and put together a podcast station. Workiva says that it's on a mission to power transparent reporting for a better world, and the company offers a software as a service platform that brings customers financial reporting, ESG, governance, risk, and compliance together in a controlled, secure, audit-ready platform. The company cloud platform is used by thousands of organizations around the world, including 85% of the Fortune 500 companies. Among its more than 6,000 customers are many NYSE-listed companies, including Hershey, which trades on the NYSE under ticker symbol HSY, Delta Airlines, which trades here under the symbol DAL, Chevron, which is the ticker symbol CVX, and Wayfair, which trades here under the ticker symbol W. Some more fun facts about Workiva is that the company was founded as a web filings company in 2008 with a goal of changing the way corporations manage and report business data. It released its first cloud solution in 2010, a time when many companies were still hesitant to trust cloud computing. And the company officially changed its name to Workiva in 2014 to keep pace with growing demand for its solutions from finance, compliance, risk, and audit teams. One challenge that Workiva is facing in all tech companies is cybersecurity threats. I was recently in San Francisco at NYSE Pacific covering RSA, one of the largest cybersecurity conventions in the world, and I spoke to some of the biggest industry leaders about the biggest challenges and trends that we are seeing in the cybersecurity sector. One of those leaders was Snyk CEO Peter McKay, who told me about his company and how it's empowering enterprises to secure AI-generated code and to scale application security programs. Let's check it out.
What Snyk does is embed security checks throughout that software development lifecycle. Snyk is focused on a category called developer security, or embedding security throughout the software development lifecycle for developers. So we've always had the North Star being helping developers be more productive. And one of the things that invariably slowed developers down is the need for them to make sure that the software that they're developing is secure.
I saw your banner. It says AI trust begins with Snyk. Can you elaborate more on that point and tell me exactly what that means?
Every developer is trying, and every CEO is trying to get more productivity out of their developers. And so what we tried to do is to encourage developers to develop incredibly fast. And now with generative AI, developers are 30, 40, 50 times more productive. And so what we try to do is be the trusted security component. So developers can continue to do the development, the creativity that they building around these applications. But security knows that because we're there, they can trust that those applications are being developed securely.
You recently released App Risk Pro.
Yes.
Tell me more about this, how it's significant, what impact it's making on the broader cybersecurity sector, and the value that it's creating for Snyk.
You know, when you think about a lot of the challenges that security CISOs and security teams face, is trying to get a complete view of my application or my applications. And so what App Risk Pro does is gives this holistic view of my application. So when you have this list of vulnerabilities to fix, you need some help understanding which ones to fix first, which are the more critical vulnerabilities from the not so critical.
We spoke last year at RSA.
Yeah.
Tell me what's new with Sneak since we last spoke.
New product, new acquisitions, strategic partnerships with ServiceNow, Google we just announced. We had SentinelOne, AWS, so good partnerships. Our team continues to get bigger and stronger as we go.
And what's next for Sneak?
Continue to execute.
Yeah.
Continue to do what we've been doing. Continue to grow a very successful software business. We've always thought of ourselves as a company, a public company someday. And if we keep executing, you never know.
If Sneak eventually goes public here at the NYSE, it may have an opportunity to ring the opening bell. Now, for some, ringing the bell is a dream come true. Earlier this month, Make-A-Wish child Luke Gettenberger opened the U.S. equity markets by ringing the opening bell. Gettenberger's goal is to be a specialized investor focused on companies seeking to cures for sickle cell anemia, which he battles every single day. He and Make-A-Wish board member John Quartzy joined our Judy Shaw to discuss how the public can support and get involved in Make-A-Wish's mission of granting life-changing wishes.
So Luke, you wanted to come to the New York Stock Exchange. You wanted to learn about stocks. Tell me about your interest in the stock market.
It all started because of my grandpa. He taught me the ropes of buying and selling. Investing in the right things. And then I didn't know this place was real when I was 16, but I had a conversation with my teacher. And then he told me about this, hey, New York Stock Exchange. So there's actually a place. Yeah. And now I'm here.
Yes, you are here, definitely. Now, John, let's talk about Make-A-Wish. For those who are not familiar, tell me about Make-A-Wish.
Yeah, Make-A-Wish has been around for 45 years or so, and the organization has granted about 550,000 wishes, even more, 580,000 I heard this morning, to children that are in need of hope, inspiration, reason to keep fighting. Obviously, children who are sick and asking for kind of what's that one wish that can really I can look forward to, that my family can look forward to. These are families that are going through a lot together, and I think it's been just fantastic to be a part of. On the New York branch, we do obviously New York centric wish granting, and I think being at the New York Stock Exchange, which is just such a fantastic, magical place, and we're talking earlier about the magic of being here. I think it's great to see Luke choosing this as his wish, this being his passion, and through a lot of hard work from people involved here, John Tuttle, Andrew Frankel, a lot of the folks who made this happen along with the Make-A-Wish team, kind of showing how we can deliver almost anything to someone who wants an inspiration to keep fighting.
Now, Luke is not terminal. He's thriving. He obviously has big dreams, and future is bright. So tell me more about that.
Yeah, I mean, that's a common misconception. I think, look at Luke, he's doing great, healthy, happy. Doesn't mean he's not, fighting like all the other children that we work with. But came here today, did an awesome job with the bell ringing, just like iconic moment. And I think, whether it's someone who's, depending on how they're doing, you could see a lot of different outcomes. But I think it's always going to be that you've got a kid who's got a reason to keep fighting, and I think that today was just a very, very happy, courageous, strong moment all around, and that was really the celebration that we had today.
Now, Luke, what does it mean to you to be here today? What are you going to do next?
Moving on to the future.
Moving on to the future, and go home and tell all your friends what you did here today at the New York Stock Exchange.
Most kids wouldn't. Most kids wouldn't realize I was a Make-A-Wish. I really didn't tell anybody, so I kept it on low. But I guess now the world knows.
Did you have a favorite part of the day today? What was your favorite part? Ringing the bell. Well, you did a great job at that. So now, John, finally tell me, how can people support and get involved with Make-A-Wish?
Yeah, so many ways. I mean, obviously, you can donate financially. You can be involved in executing the wish, granting the wish. Look at today; it looks seamless, but there's so much hard work that went into it by the Make-A-Wish team, by the stock exchange of making it happen. And so you can deliver that wish and be involved in volunteering that way. But I think any way to just make the organization, which is already well known, spread the word, talk about it with your friends and family, and the more support, the better. But those are the main ways that people can get involved. And I think that anybody can be involved in some way. It doesn't have to be just financially. It can be just devoting some time and passion into it.
Now, switching gears a little bit, consultancy firm Edelman recently published its 24th annual Trust Barometer report, which gains insight into how people around the world trust governments, businesses, and, well, the media. More than 32,000 respondents across 28 countries participated in the 2024 survey. Deidre Campbell, managing director at Edelman Smithfield, joined me earlier this afternoon to break it all down.
We ask respondents how they feel about trust in government, in business, in NGOs, and the media in their country. We look at those institutions because we believe that whether they are trusted or not, it will have outsized impact on that society. We use the data to help clients build trust-building strategies that will allow them to improve their businesses and improve the societies in which they work.
And what were the key findings?
So here's the big headline for financial services. Financial services is trusted globally for the first time ever. Wow. You enter into the trusted category at 60 on a 100-point scale. Financial services is now at 62. It's up 4 points from last year. So that's exciting. Also trusted globally are banks. So we see banks trusted at 65%, again, firmly in the trusted category. In the US, still in the neutral category.
Why do you think this was? Why do you think these findings were so revealing that people are actually trusting financial institutions and banks and insurance companies?
Well, it's interesting because we really have a tale of two trust surveys. When we look at the respondents to the survey, half of the countries that we survey are in the trusted category, half are in the distrusted category. And when we look at this, it is the developing countries that are in the trusted category, and the developed countries very much not in the trusted category. And we look at the relationship that consumers are having with their banks and their financial services institutions very differently depending on sort of where you sit in the world. Do you have a banker? Do you know your banker? Do you go and see your banker? Where in the developed countries, we've really become very technologically savvy and dependent, but yet those technologies don't have a face. And we're still worried about the pace of innovation. We're worried about, are they going to take my jobs? We're worried about, can I trust them with things like trading algorithms? Yeah. And so there's still a lot of skepticism as it relates to developing countries.
Yeah, we were actually talking about that, the rapid development of technology and AI and how its impact on this survey was, right? I mean, that human capital aspect really proved to be a vital part of why people are trusting financial services and stuff in these underdeveloped countries.
Absolutely. And I think what the survey tells us is when the technological institutions slow down to explain the technology, to be very transparent about the technology, to understand, to better explain safeguards, to seek regulatory environments that are going to protect consumers. Those are going to build trust scores and build adoptions of those technologies once people start to get more comfortable with them. You know, it's interesting. In 2016, the Edelman Trust Barometer absolutely foretold the period of polarization that we were entering into in the United States.
Now, according to your study, nearly half of the world's population will be eligible to vote in elections this year. It's an election cycle, obviously. How do you think the results from this survey will have implications on this election?
I can speak to the implication that they'll have in the United States. In 2016, the Edelman Trust Barometer absolutely foretold the period of polarization that we were entering into as a country, with high-income earners reporting that they trusted all four institutions that we survey and low-income earners not trusting. As we enter 2024, Republicans are telling us that they are neutral on business. Democrats are telling us that they are neutral on business. But Democrats trust the other three institutions while Republicans do not. So you see, a very divided partisan lines heading into the election cycle.
Where do you think people can get their trusted news from?
What we see as most trusted, interestingly enough, is search engines. Traditional media is not trusted, journalism's not trusted, owned channels are not trusted, but the idea of being able to go to your search engine and look, search up what you're looking for and to see 3 or 4 trusted sources that you believe in bringing you the same information, it's that aggregation and confirmation of data from institutions that you trust in the media. In terms of trusted voices, it's teachers, it's scientists, it's my CEO, but not CEOs in general. CEOs are in the neutral category, but I trust my CEO. Journalists are at the very bottom.
The average 30-year mortgage rate fell below 7% threshold for the first time in over a month. Meanwhile, the average 15-year mortgage rate also declined slightly, sitting at just over 6.2% as of May 23rd. Now, while that's a good news for prospective home buyers, this isn't. Fresh data from the S&P CoreLogic Case-Shiller U.S. National Home Price Index, which measures home prices across the country, jumped 6.5% in March from a year earlier to a record high. Now, it's the 6th time the index has reached a new record high over the past year. Now, to help potential homebuyers navigate this ever-changing market, the ICE Mortgage Monitor provides a view of the current mortgage market, including loan level performance, home price trends data, secondary market metrics, and public records. Andy Walden, Vice President of Enterprise Research Strategy at ICE, takes a closer look at the latest data.
Hey, this is Andy Walden from ICE Research and Analysis, here with your latest look at the housing market. There were some calendar-related effects that impacted performance in the month of March. We expect those to rebound in April, but overall delinquencies continue to run very, very low. And when you look at foreclosure activity, we continue to see foreclosure volumes on the start and active foreclosure inventory that are 30% below pre-pandemic levels. Foreclosure sales are 50% below pre-pandemic levels. Serious delinquencies hit their lowest levels since the middle of 2006, and so that pipeline heading into foreclosure continues to remain low. So overall, from a mortgage performance standpoint, the market continues to remain very, very strong. That's been the story of the market over the last 3 years. Those that have the deepest inventory deficits are seeing some of the strongest housing markets from a price perspective, and those markets that have moved above pre-pandemic levels or even gotten near pre-pandemic levels in terms of inventory have seen prices really begin to soften. Home prices are up about 5.6% from where they were at the same time last year. At the same time, interest rates roughly 0.75% higher than they were last spring as well. And you put those two effects in combination out there in the market, and what you're seeing is that it now takes about 36% of the median household income to afford the median home in the US. That's a backtrack from where we got to kind of in early January this year when interest rates had eased. And again, that makes April one of the 6 least affordable markets or least affordable months over the last 36 years, 38 years out there in the market. And so you are seeing that affordability pressure build out there. When you start to look at kind of forward-looking expectations for home affordability and interest rate easing and what dynamics it would take to bring us back into that long-run balance, I mentioned it currently takes about 36% of the median household income to buy the median home. It usually takes less than a quarter. We usually, on average over the last 30 years, run in that 24, 25% range. In order to bring us back into balance, it's going to take, interest rates at half their current level, and or incomes growing by 50%, and or home price reductions by 33%, right? Would be any one of those individual needle movers, what it would take to bring us into balance. Obviously, that's none of those three are in the near-term forecast, right? So it's going to take kind of a long-run approach and an extended period of time to bring the market back into balance from an affordability equation. It's probably going to take multiple of those needles, if not all three of those needles, moving in tandem for a period of time to kind of help bring us back into balance. We talk about home prices and interest rates and their impact on prospective home buyers. But what we also see in the market right now is that record level of home price growth that we've seen over the last 4 years is really to the benefit of existing homeowners. And when we look at debt leverage in the market, the average mortgage holder has 55% equity in their home right now. And when we look at the amount of equity that's out there that could be lent against in a relatively safe manner while still keeping 20% equity in a home, we're at a record $11 trillion of what we call tappable equity out there in the market. And as we all know, existing mortgage holders are sitting on extremely low interest rates. And so it provides a lot of opportunity for folks looking in that home equity lending space. We're looking at record levels of equity. We're also looking at equity where 2/3 of that's held by borrowers that have 760 credit scores or higher. A similar 2/3 is held by borrowers that have interest rates on their first mortgage that are less than 4%. 84% of that equity is held by folks that have interest rates below 5%. Right? So it creates this dynamic where we have a lock-in effect, as we all know, on those existing homeowners, less incentivized to sell their home. But it also creates an environment where it makes a lot of sense to keep that first lien mortgage and maybe tap into some of that equity as folks are looking to renovate and stay in their homes longer. That second lien lending becomes more and more of a topic of conversation, and you're seeing more and more lenders that are exploring those types of products to fulfill those types of needs for homeowners. And this is Andy Walden with ICE Research and Analysis. Talk to you again next time.
All right, I am joined now with Caleb Silver, Investopedia Editor-in-Chief. Good afternoon, Caleb.
Good to be with you as always.
Yeah, it's great to have you again. And I just want to point out right now that the executive team is right there by the distinguished guest book, getting ready to etch their name in this book. We're going to captivate everything that's happening here on the floor as dozens of their friends, colleagues, and team workers are going to be filtering right here in front of CNBC set as we get ready to close out the U.S. equity markets. But speaking of the market closing, Caleb, let's kind of talk about what has been moving markets today. What have been the biggest headlines and market movers?
Yeah, another sell-off, and especially for the Dow Industrials. Why is that happening? Anytime the 10-year yield hits that 4.5% mark, stocks go down. I don't care if you're NVIDIA or if you're a Dow Industrial, if you're a component like Caterpillar. That is a magic number, and that turns investors the other way because they have alternatives. So we're seeing that. We're seeing a sell-off on a lot of healthcare stocks, in the Dow 30. That's dragging the market lower too. But if you haven't noticed, during this whole rally to market highs, consumer discretionary stocks have not really played in that. Amazon, the one that's listed here on the Dow as a Dow component, but in general, you haven't had that. So if you don't have that participation, markets usually don't have enough strength to keep rallying to new highs.
Take our viewers through what a T+1 settlement is. What exactly is this? Explain to our viewers, break it down for us.
Yeah, T+1. This is a new settlement procedure here for the New York Stock Exchange that's actually a century old. That means by the time you execute a trade, buy or sell a stock, it is 1 day, 24 hours or less before that stock is settled. The money changes hands from you to your broker or from buyer to seller. Now we're going from a T+2 settlement date. That's where it's been since the 1990s. But just so you know, 100 years ago, right here on the floor of the stock exchange, it was T+1 because I would create a stock order, a buy order, I would bring it to you, you'd fulfill the order and hand me back a piece of paper. We were fulfilled in the same day. Then trading volume expanded. It really blew up in the 70s and it really blew up in the 90s. 12 million shares were trading hands. So the New York Stock Exchange created book entry so that we would record those trades, and then they made it available for digitization. Eventually, 20, 30 years later, they've been moving from T+5 settlement dates to T+2. Now we're at T+1 today, and today is that double day settlement where we go from T+1 T+2 to T+1.
So wait, why did Wall Street move away from this model? Why do you think they're bringing it back now?
Oh, they moved away from it because trading volume expanded and there was no way to keep up with the amount of trades that were going on. Well, technology got better. We were able to record trades a lot faster. If you see, all the trading here is done through tablets. It's all being electronically recorded. So it's a lot easier now to trace these trades and then fulfill them, make sure that money moves from buyer to seller, broker to dealer, within 24 hours. Now, the rest of the world has to catch up with this because this is a big move by the United States exchanges, but it's going to take the rest of the world a long time to get to it.
But, you know, I want to point out, you mentioned a really good point, how we use first-in-class technology to really move these orders. However, what sets us apart from any other exchange in the world, and you might know, is the fact that we have a DMM, a specialized trader, designated market maker that stands with the stocks, over 2,400 listed companies that are here at the NYSE to really navigate through that market volatility.
Yeah, and that's probably the point of a lot of this. T+2 meant it took 2 days for the money literally to transfer from your brokerage account to the seller of that stock. That's too long. Too many things could happen. A buyer could back out, a seller could back out. So the fact that you were able to clear those quickly is important. And the fact that the New York Stock Exchange established book entry to get this whole process started 30 or 40 years ago made this T+1 possible. So the idea behind T+1 is that there's less time for buyers or sellers to back out of a trade, for mistakes to happen. The thing that you have to be careful of, because settlements are going to happen within 24 hours, is that you don't make a mistake, because it is harder to back out of that trade if you only have 24 hours.
You know, I want to point out we're going to be getting images right now of the executive team make their way up to the secret staircase, I like to call it, behind the Bell podium, as they make their way up to get ready to close out the markets. But, you know, I want to go back to this. How should investors be preparing right now for this big move?
Yeah, investors like you, me, and a lot of people don't really need to care about it. We make a trade on our online brokerage account. It goes through pretty much close to the price. We decided we wanted it.
I just love when we have a crowd like this. I mean, this is just another day here at the exchange.
Television, let it rip, let it rip. So we don't have to worry as retail investors. Institutional investors need to pay attention to this because they're not just trading stocks, they're trading foreign currencies, they're trading bonds. Those don't all settle T+1. So institutional investors need to be prepared for this. You see a lot of foreign firms now moving traders to the United States so they can be within that 24-hour range. And you see a lot of other traders trading houses outside of the United States, opening maybe on a Sunday or staying open later on a Friday to make sure they're in the 24-hour range.
What do you think are the challenges that the SEC might face or encounter as they prepare for this move?
Well, the fact that the United States is the only country doing this right now, actually that's not totally true. We do know that Canada and Mexico also moved to that today, but other big markets, think about Europe, think about China, think about Japan, they're still in a T+2. So the transaction settlement time is going to be different here than it is there. That's going to take some catching up with, and that's going to take some good technology to make sure that you know the price at which you executed your orders.
Let's talk about the long term of this effect, right? What do you think the T+1 effect will have on long-term investing?
On long-term investing, this is not going to have too much of an impact because, again, this is for institutions who are moving millions of trades, billions of dollars a day to make sure their transactions are settling within 24 hours. For the rest of the world, individual investors, people buying off their brokerage accounts, it doesn't make that big of a difference, but institutions need to be prepared for it because they're the ones that are moving trillions of dollars every single day.
Is there anything else at the forefront that investors should be looking out for?
Investors should always be looking out for volatility, especially when we're not expecting it, and be prepared for the unexpected. But in general, we're at a time of higher highs in the stock market. Great time to be an investor. Companies are buying back their shares, they're issuing dividends. We're going to get lower interest rates eventually. Record highs usually beget record highs. So if you're a long-term investor, stay the course. You love times like this.
Stay the course. You heard it here first. Well, thank you so much, Caleb. It's always great to have you on our show.
Thank you. Thanks for having me.
All right, now we're just about 90 seconds out from closing out the U.S. equity markets. I want to get a big shot of this crowd, though. I mean, look at this. Just a little preview. I mean, they're going to be much louder when we close out the markets in literally just 60 seconds. But right now, look, this is CNBC's set. We're probably disrupting their afternoon broadcast, but we like to do that here. But I want to talk to you guys a little bit more about the New York Stock Exchange here and the designated market maker model that we have. This is an active trading floor. We have around 200 specialized traders right now that are placing in orders, getting those final orders put in before we close out the U.S. equity markets right now in about 40 seconds right now. And everybody is going to be watching their team close out the U.S. equity markets. Around 100 million people from around the world could be tuning in to this moment at any given time, but I'm going to turn it over to them. I'm Trinity Chavez. Thank you so much for watching.
Iconic brands speak for themselves. The strongest brands stand the test of time. We are so excited to welcome you to our community. Today is all about you.
We've never lost sight of what we're trying to do and deliver that mission.
Going through this experience with my partners and my families has been unbelievable.
We imagined something that didn't exist yet, and we believed that we could do it.
You're going to look back on this accomplishment as one of the finest you've ever done.
I want you to know that the best is yet to come.
Just a few minutes, we'll go downstairs to the legendary New York Stock Exchange trading floor to ring the opening bell. The history here, the tradition, it's just incredible for us to be at this moment.